Okay, so in this presentation, the assumption is that you've already listened to the Chapter 3 lecture. And so we'll go through several examples. There's actually quite a few here from Chapter 3 to hopefully prepare you for the homework and also for the exam that's coming up here in, a week or so. So let's dive in. Okay, so Pablo Management has 5 employees, each earn $250 per day. They're normally paid on Fridays for work completed Monday through Friday of that same week. So if we assume that December 28th was a Friday, they were paid in full for that week. So then the next week, the 5 employees worked only 4 days because New Year's Day was an unpaid holiday. So in Part A, we're to assume that December 31st was a Monday, and we're to prepare the adjusting entry that would need to be recorded at the close of that day because they're not going to get paid until that Friday, right? So if we have 5 employees, right, each earn $250 per day, and let's see, and December 31st is a Monday, right? So that means that we only have to accrue for 1 day in Part A, right? So 1 day times 250 per day, right? I got a new stylus. I'm not sure how I like it. 250 per day times 5 employees, right? So 1 times 250 times 5, that means we record a wage expense of $1,250. And the other side of our adjustment is accrued wages or wages payable, same thing. Okay? For $1,250. So wage expense is a expense account, obviously. To increase expense accounts, we debit. And then wages payable is that key word that indicates it's a liability, right? And we increase liabilities with credits. Okay, so that's Part A. So then in Part B, we're to assume that January 4th was a Friday, and we're to prepare the journal entry that would be made to record the actual payment of those wages. Okay, so if that week is only a 4-day week, and January 4th is a Friday, I believe we would have 4 days times $250 per day times 5 employees, right? So let me get out my handy dandy calculator because I can't do that math in my head. Don't tell anybody. 4 times 250 times 5. That's $5,000 of total wages that they're going to pay on January 4th. However, we've already accrued $1,250 of them, right? So what's going to hit our expense in the current year is going to be $3,750. Let's see if I'm right. All right, so our wage expense for the current year is only going to be 3 days at that $250 rate times 5 employees, right? Yeah, so 3 days at $1,250, $3,750 of wage expense for the current year. We're going to reduce our wages payable because we're paying that day of wages that we accrued, right? So to reduce a payable, we debit. And then our total cash that we're paying out the door, $5,000. Okay? Easy peasy lemon squeezy. All right, so this is the exact same question, just different numbers. So why don't you pause the recording, take a minute to see if you can't figure it out on your own. And then when you get stuck and or you think you've figured it out, resume the recording and we'll go through it together. All right, so Pablo Management still has 5 part-time employees, right? This time they earn $300 per day. They're paid on Friday for Monday through Friday of that week. We're to assume that December 28th was a Friday. They were paid in full on that day. The next week, the employees only worked 4 days because New Year's Day was an unpaid holiday. So if we assume that December 31st was a Monday, prepare the adjusting entry that would need to be recorded that day. So in this case, we have 1 day times $300 per day, right? Times $300 per day times 5 employees. So what is that? That's $1,500, is that right? So we have wage expense for 1 day times 5 employees times $300 per day, $1,500. So we debit wage expense to increase it because we want to record the expense in the current year. Doesn't matter when we pay it. And then we have wages payable of $1,500. Okay. So then if we assume Friday, January 4th, they paid the employees for that week. So we've already accrued one of the days of the 4 days they're going to work that week in our entry here on the screen. So when we go to pay our employees for the 4 days that week, the total cash out the door is going to be 4 times 300 times 5 employees, right? So 4 days total cash that we're paying for that payroll, 4 times 300 per day times 5 employees, we're going to pay a total of $6,000. That's how much cash is going to go out the door. But some of that is related to expense from the prior year, and some of it's related to expense for the current year, right? So our wage expense for the current year is only the remaining 3 days because we already accrued one. 3 times 300 times 5. It's $4,500. It's going to be our wage expense for the current year. So it's that Wednesday, Thursday, Friday at $1,500 a day, or $4,500 for the 3 days. So we're going to debit wage expense for $4,500. We're going to reduce our payable because we're getting ready to pay it, right? So we had a credit balance in our payable of $1,500. Now we're going to debit to take it to zero because we're paying it. And our cash out the door is $6,000. Okay? So hopefully that you did well on that problem. Let's move on to the next. Okay, so in this example, they give us 3 separate situations, and they're asking us to prepare the adjusting journal entries so that we can prepare financial statements as of April 30th. And we're supposed to assume that for each situation, we're supposed to present the April 30th adjusting entry and the subsequent entry during May to record the payment of the accrued expenses. So let's look at A, B, and C individually here, and we'll do so on the next slide. Okay, so on April 1st, the company retained an attorney for a flat monthly fee of $3,500. Payment for the April legal services is paid on May 12th. So we're to assume that sitting here at April 30th, we're trying to close our books and reports or create our financial statements for April 30th. The reason why we have to make an adjusting entry is because no cash activity has taken place with respect to this transaction, and so therefore it is not yet recorded in our books and records. And so that they're telling us the company retained an attorney, but they haven't yet paid that attorney. But here's the deal. Because they've retained the attorney, we have to record something in our accounting records. It doesn't matter if we haven't yet paid for it, right? So we're going to accrue for that payment that we know we're going to have to make in the next month. And so the way that we do that is we record our expense and record our liability or our obligation for that future payment. And so in order to increase our expense for legal fees, right, we do that with a debit, $3,500. And then in order to record our liability for those legal fees that we're going to owe in a future period, but we've incurred today, record a legal fee payable, and we increase payables with credits. Okay. Then on May 12th, when we pay them, cash is going out the door, right? So to decrease cash, what do? We credit, right? And then we relieve or we reduce our payable account, right? That we recorded on April 30th. To decrease a liability, we debit. And to decrease cash, we credit. Okay? All right. So in Part B, as of April 30th, the company has accrued interest expense $3,000 on a note payable that they have. And they tell us that the full interest payment of $9,000 is going to be due on May 20th. And so before we close our books on April 30th, we need to accrue for that interest expense that's accrued through April 30th on our note payable. And so to do that, we're going to have interest that's due in the future, but is incurred today and needs to be recorded. So we have interest expense. We increase expenses with debits. So there's our $3,000. We have an interest payable, right? And a payable means it's a liability, and liabilities are increased with credits. And then on May 20th, when we pay it, we're going to have cash out the door of $9,000. And to reduce our cash, we credit. And we're going to reduce our interest payable because we're going to pay it. So we no longer need that liability on our books, right? So we reduce our interest payable by $3,000. And then our plug to interest expense is the difference between the two because our debits have to equal our credits, right? All right, and then in Part C, total weekly salaries for all employees is $10,000. The amounts paid at the end of the day on Friday of each 5-day work week. So they tell us that on April 30th, that was a Tuesday, which means that the employees worked 2 days since the last pay period. And the next pay period isn't until the next month. Okay, so we have to accrue 2 days worth of salaries, right? So I think if we take $10,000 per week divided by 5, right? That means it's 2,000. Gosh, that's super messy. Let me try again. That means it's $2,000 per day in salaries, right? So if we're going to accrue 2 days worth on April 30th, since they're not going to pay it until the next month, we want to make sure that we still record the expense in the current period. So we're going to record salaries expense, $2,000 per day times 2 days, $4,000. We're going to record a salary payable. We're going to owe it, just not today. We're not paying it. We're going to pay it next month. So we have salaries payable credit of $4,000. Then on May 3rd, when we pay it, what we're paying on May 3rd is 3 days in May and 2 days in April. So our salary expense for the period of May is going to be 3 times 2, or $6,000. We're going to reduce our salaries payable for the other 4, and we're going to pay cash out the door, a reduction reflected as a credit of $10,000. Okay? All right, so here's the exact same problem, but different numbers. Why don't you pause the recording, take a stab at this one, and then when you're finished, you can resume the recording, and we'll go through the answers. Okay, so on April 1st, the company retained an attorney for a flat monthly fee of $2,500. Payment for the April legal services is going to be paid on May 12th. So just because it's not going to be paid till next month doesn't mean we didn't incur the expense today, and we have to properly reflect that expense in our accounting records for the April 30th financial statements, right? So to do that, we record legal fee expense of $2,500, and we record a legal fee payable of $2,500. Then on May 12th, when we pay it, we debit our payable, $2,500, and we credit cash. $2,500. Okay. So in Part B, as of April 30th, $700 of interest expense is accrued on a note payable. The full interest payment of $2,100 on the note is due May 20th. So before we close our books in April, we want to reflect that interest expense and the fact that we owe it and we just haven't yet paid it. So we're going to record interest expense of $700 and we're going to record an interest payable of $700. To increase expenses, you debit. To increase liabilities, we credit. And then on May 20th, when we pay it, we're going to reduce our interest payable. We're going to credit our cash for the entire amount of the interest of $2,100. Reduce our interest payable for $700, and then the plug to make our debits equal our credits is a debit to interest expense for $1,400. All right, and then in Part C, total weekly salaries for all employees is $15,000. The amount paid at the end of the day on Friday of the 5-day work week. April 30th falls on a Tuesday, which means employees worked 2 days since the last payday. The next payday is not till May 3rd, and so we have to figure out how much we need to accrue so that we record the proper amount of salary expense in our April financial statements. So $15,000 per week divided by 5, I can do that math without a calculator too, so go tell everybody that. All right, so that's $3,000 per week, right? Or per day, sorry. All right, so on April 30th, we want to record our salaries expense for the 2 days the employees have worked. So that's 3,000 times 2, that's $6,000. And we're going to record a salaries payable that we're going to pay on May 3rd of $6,000. Then on May 3rd, when we pay it, we're paying for 3 days in May, so 3 days times 3,000 per day. We have salaries expense for May of $9,000. Salary payable, we're going to reduce because our $6,000 we already recorded in expense. Now we're just removing it from the payable and we're paying it. And then we have a credit to cash for that whole $15,000. Okay. All right, hopefully you did well on that one. As always, if things aren't clicking or you have questions, feel free to ask. All right, so in this example, they're asking us to prepare adjusting journal entries. And so prepare the adjusting journal entries for the year ended December 31st. For each of these separate situations, we're supposed to assume that prepaid expenses are initially recorded to asset accounts, and we're to assume that fees collected in advance of the work are initially recorded as liabilities, okay? So 2 reminders before we look at each of these individual situations. Reminder number 1, the purpose of adjusting entries is to ensure that all the asset and liabilities and the resulting revenues and expenses are properly valued, or that we're recording the expense in the proper period, you could say it that way as well, prior to the preparation of financial statements. And then reminder number 2 is that every adjusting entry affects one balance sheet account, an asset or a liability, and it affects one income statement account, a revenue or expense. Adjusting entries do not, never, ever, 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 ever affect cash. Okay? All right, let's go. So question A, or part A. Depreciation on the company's equipment for the year is computed to be $18,000. So we're talking about depreciation expense, right? So what's our current account balance equal? We can presume 0. What does it need to equal? 18,000, right? So how do we make that happen? Depreciation expense is an expense account. To increase expense accounts, we debit, right? So in order to get from 0 to 18,000, what's our entry? Debit depreciation expense, right? And credit accumulated depreciation, which is our contra asset account, which works the opposite of a regular asset account. So we credit contra asset accounts to increase. Whereas normal asset accounts, we debit to increase. Okay? Easy peasy. There's the other side of our T account, $18,000. All right, so in Part B, prepaid insurance account had a $6,000 debit balance at December 31st before adjusting for the cost of any expired coverage. An analysis of the company's insurance policies showed that $1,100 of unexpired insurance coverage remains. What does our account equal? 6,000, right? What does our account need to equal? 1,100, right? They give us those answers. So how do we get from $6,000 in a prepaid insurance asset account to $1,100? We need to decrease it, right? We decrease assets with credits, right? So we have a credit to prepaid insurance for $4,900 and a debit to insurance expense for $4,900. Okay? And there's your other T account. All right, in letter C, the office supplies account had a $700 debit balance at the beginning of December and a $3,480 worth of office supplies were purchased during the year. And the physical count shows $300 of supplies available. So, what does our account equal? Well, you started with 7, you added $3,480. So it looks like our account equals $4,180, right? It needs to equal 300. And so to reduce our office supplies account from $4,180 to $300, we need a credit, right? So we credit our office supplies asset account and we debit our supplies expense account for $3,880. In letter D, 2/3 of the work related to $15,000 of cash received in advance was performed this period. So our account balance equals currently $15,000 in our unearned fee revenue, right? And they tell us 2/3 of the work was performed, so that means 1/3 remains. 1/3 of 15,000 is $5,000, right? That's what we want our account to equal. So in order to reduce our liability, we need a debit of $10,000, right? So we debit our unearned fee revenue and we credit revenue because we've earned that revenue now, right? $10,000. There's our other T account, our fee revenue. Credit of $10,000. All right, in Part E, prepaid insurance account had $6,800 debit balance at December 31st of the current year before adjusting for any costs of unexpired insurance. An analysis of the insurance policies shows that $5,800 of coverage has expired. So that means our balance equals $6,800. It needs to equal 1,000 because they tell us 5,800 is expired, right? And so in order to reduce our asset account prepaid insurance from 6,800 to 1,000, we reduce assets with credits. Credits get posted to the right side of our T account, right? So our journal entry is going to be a credit to prepaid insurance and a debit to insurance expense for that $5,800 that's expired. Okay? All right, in Part F, wage expense of $3,200 has been incurred but has not been paid as of December 31st. So our balance is currently 0 and our wage is payable. It needs to be $3,200. And so in order to increase a liability, we increase liabilities with credits. So we need a credit to wage expense of wages payable, sorry, of $3,200, and we need a debit to wage expense for $3,200. Okay. Okay. All right, so this is the exact same problem, different numbers. Why don't you take a few minutes, pause the recording, you know the drill, give it a try, and when you think you're finished and or you are stuck, resume the recording and we will go through the answers. All right, part A, depreciation on the company's equipment for the current year is computed to be $20,000. So determine what our depreciation expense account equals. 0. What does it need to equal? 20,000. The way we do that is we debit depreciation expense for 20,000. We credit accumulated depreciation, that's our contra account, for $20,000. In Part B, the prepaid insurance account had $4,000 debit balance at December 31st, before adjusting for the cost of any expired insurance. An analysis of the company's insurance policies showed that $1,500 of unexpired insurance coverage remains. So determine what the balance equals. It equals 4,000. What does it need to equal? $1,500. And so how do we do that? Credit of $2,500, right? So we debit insurance expense for $2,500 and we credit prepaid insurance for $2,500. Okay. Okay, in Part C, the office supplies account had a $900 debit balance at the beginning of December. $4,100 of supplies were purchased. Physical count showed 300 available at the end of the period. So determine what our account balance equals. 4,100 plus 900 is $5,000. What does it need to equal? 300. To get an asset account from a balance of 5,000 reduced to a balance of 300, we credit, right? Credit to reduce assets. So we have a credit to our office supplies asset account of $4,700. And we have a debit to office supplies expense for $4,700. In Part D, 2/3 of the work related to $24,000 of cash received in advance was performed for the period. So determine what our account balance equals. It equals 24,000, our unadjusted fee revenue liability account. 2/3 of the work was performed, which means the balance needs to be 1/3, or $800, or $8,000, excuse me. And so to get from a credit balance of 24,000 to a credit balance of 8,000, we need a debit to reduce that balance of $16,000. So we have a debit to unearned fee revenue of $16,000 and we have a credit to fee revenue of $16,000. In E, the prepaid insurance account had $3,500 debit balance at December 31st before adjusting for any cost of unexpired or of any cost of expired insurance coverage. And then the analysis of the insurance policy showed the $2,200 of coverage had expired. So our balance currently equals $3,500. Our balance needs to equal 35 minus 22, but $1,300, is that right? And so to reduce an asset account, we credit, and we need a credit equal to that $2,200, right? So we credit prepaid insurance, $2,200, and we debit insurance expense for $2,200. Right, in Part F, wage expense of $900 had been incurred but not paid as of December 31st. So we need to record that expense and record the payable. So our balance currently in our wage payable is 0. Our balance needs to be $900. And so in order to increase a payable account, it's a liability we credit. So we have a credit to wages payable for $900 and we have a debit to wage expense for $900. Okay, so preparing adjusting entries. So for each of the following cases, they're asking us to prepare the adjusting entries. So we're to assume that prepaid expenses are initially recorded in asset accounts and that fees collected in advance of the work are initially recorded as liabilities. So in A, wages of $8,000 have been earned but not paid. So our wages payable is 0, but it needs to be $8,000, right? So to increase our wages payable account, it's a liability. Liabilities are increased with credits. So we have a credit to wages payable for $8,000 and we have a debit to wage expense for $8,000. In part 2, or letter B, depreciation on the company's equipment for the current year is $18,000. So our balance is currently 0. It needs to be 18. To get from 0 to 18,000 in an expense account, expenses are increased with debits. So we have a debit to depreciation expense, and we have a credit to accumulated depreciation. Okay, so in part C, the office supplies account had a $240 debit balance at the beginning of December. During December, $5,200 of office supplies are purchased, and the physical count says we should have $440 of office supplies available at the end of December. So, what is our current account balance equal? $240, right? Plus $5,200 of the purchases for a total of $5,440. And our balance needs to equal $440. So to get from $5,440 debit balance in office supplies to a debit balance of $440, our balance needs to decrease. We decrease balances in asset accounts with credits, and in this case, a credit of $5,000, right? So we have a credit to office supplies for $5,000 and a debit to office supplies expense for $5,000. There you see your debits posted on the left side of the T account for office supplies expense and your credits posted on the right side of the T account for the office supplies asset account. Okay. All right, in letter D, the prepaid insurance account had $4,000 at December 31st of the prior year. An analysis of the insurance policy shows that we should have $1,200 of unexpired insurance benefits to remain. So what does our balance equal? $4,000. What should it equal? $1,200. We reduce balances in asset accounts with credits. So 4,000 minus 1,200, 2,800, right? So we have a credit to prepaid insurance for 2,800 and we have a debit to insurance expense for 2,800. In letter E, the company has earned but not recorded $1,050 of interest from investments in CDs for the year ended December 31st. Interest revenue will be received on January 10th of the following year. Well, we still want to record that revenue in the current year, right? So our interest receivable account is currently 0, but it needs to be $1,050 to increase a asset account, in this case interest receivable. We debit. So we have a debit to interest receivable and we have a credit to interest revenue. In letter F, the company has a bank loan and has incurred but not recorded interest expense of $2,500 for the year ended December 31st. The company must pay the interest on January 5th of the following year. So what does our account equal? 0. What should it equal? Oh, there's the answer. My animation's all mixed up. It should equal $2,500. And so to increase a payable liability account, we credit. So we have a credit to interest payable, $2,500, and a debit to interest expense for $2,500. Right? All right, so this is the exact same problem, different numbers. Take a few minutes, see if you can record all of these adjustments. And then when you're finished, you can resume the recording and we'll go through the answers. All right, so letter A, wages of $3,000 have been earned but not paid. Our balance is 0 in wages payable. It should be 3,000. You increase liabilities with credits, so we have a credit to wages payable. We have a debit to wage expense. In letter B, depreciation on the company's equipment for the current year is $8,500. Our depreciation expense is currently 0. It needs to be $8,500. We increase expenses with debits. Debit of 8,500 gets us from 0 to 8,500. Debit depreciation expense 8,500 and credit accumulated depreciation of 8,500. Remember, accumulated depreciation is a contra asset account, so we increase it, doing the opposite of what we do with all of our other asset accounts. Right, in letter C, office supplies had a debit balance of $200 beginning in December. During December, $6,400 of office supplies are purchased. Physical count shows there should be $500 left yet to be used at the end of the year or end of the month. So our balance of office supplies asset account is $6,600. That's $6,400 plus $200. Our balance should be $500. To get from $6,600 to $500, we need to reduce our office supply asset account. To reduce asset accounts, we credit, and in this case, by $1,100. Or by, I'm sorry, $6,100. So office supplies credit for $6,100. Office supplies expense debit for $6,100. There you see your T accounts. You have a debit on the left side, credit on the right side, right? Right, in letter D, the prepaid insurance account had a $5,000 balance at the beginning of December. Analysis of the insurance policy shows $900 of unexpired insurance benefits remain. So our balance in prepaid insurance is $500. It needs to be $900. To get from $5,000 to $900, we need a credit, right? We reduce our asset accounts with credits, and in this case, a credit of $4,100. So we credit prepaid insurance for $4,100 and we debit insurance expense for $4,100. Right, in letter E, the company's earned but not recorded $800 of interest from investments in CDs for the year ended December 31st. Interest revenue will be received on January 10th of the following year. Well, if we've earned that interest, we have to record it, right? So our current interest receivable account is 0, but it needs to be $800. To increase an asset account, we debit, in this case, $800. Debit interest receivable, $800, and we want to recognize our interest revenue, and we increase revenue accounts with credits. So we have an $800 credit to interest revenue. All right, in letter F, the company has a bank loan that has incurred but not recorded interest expense of $1,400 for the year ended December 31st. The company must pay the interest on January 5th of the following year. So we want to recognize that interest expense and that interest payable. So our balance is 0. It needs to be $1,400. We increase liability accounts with credits. So we need a credit of $1,400 to interest payable and a debit to interest expense of $1,400. Okay, so analyzing and preparing adjusting entries. So the following are two income statements for a Lexus company. The left column has the unadjusted trial balance. The right column is from the adjusted trial balance. And so they want us to analyze the statements and prepare the 7 adjusting entries that were likely recorded. Okay, so if we look at the revenue section of the income statement first, it looks like commissions earned hasn't changed at all, right? So there's nothing to look at there. But fees earned have increased from 18,000 to 25,000. So what's that? That's an increase of 7K, right? And they tell us in the hints that, I'm assuming this is A, they don't tell us it's A, but I'm assuming in the hint it says that the entry for A, which is this first one we're working on, refers to fees that have been earned but not yet billed. And so what that tells us is there's no account receivable on the books before the adjustment was made. And so our debit is going to be to accounts receivable for 7 and the credit to fees earned for 7. Your fees earned increased by 7, so you know this answer. And the hint tells you, if it hasn't yet been billed, what's happening when they make the adjustment is that they're recording the account receivable. Accounts receivable get on the books when you do your billing. Okay? All right. Okay, so now let's look at the expense side and figure out what balances have changed and what entries look like they've been made, right? So depreciation expense, we started at 0 and we got to $1,600. And we started at 0 here and we got to $1,850. So we must have recorded some depreciation expense as 2 of our entries. So to increase depreciation expense for computers, what would we have to do? It's an expense. We increase expenses with debits, right? So we would have debited depreciation expense and we would have credited accumulated depreciation, right? And the same thing would have been true with our office furniture. So we debited office furniture depreciation expense for $1,850 and we credited accumulated depreciation office furniture for $1,850. Okay? All right, so now we've done our fees earned, commissions earned didn't change, depreciation expense we've handled. It looks like our salaries expense went from 1,000 or 13,500 to 15,750. So we must have accrued some additional salary expense, right? So we know to increase salary expense we have a debit. So we would have debited salary expense for 2,250. And the other side would have been to salaries payable for 2,250, right? And then our next entry, let's see, insurance expense was 0, and then it went to $1,400. So in order to increase our insurance expense account, we debited for $1,400, which means we credited prepaid insurance for $1,400. All right, so rent expense didn't change. The next account that changed is office supplies. It went from 0 to $580. So in order to increase office supplies expense, we would have had to debit office supplies expense for $580. And we would have credited office supplies for $580. And then our advertising expense did not change. Our utility expense did from $1,245 to $1,335. So in order to increase utilities expense, we debit. The difference between the two numbers is $90. And then we have utilities payable, credit for $90. Okay? All right, so this is the exact same problem, just different numbers. So why don't you pause the recording, take a stab at it yourself, and then when you're finished, resume the recording and we can go through the answers. All right, so let's first look at revenues. So it looks like fees earned changed from 1,200 to 2,100. So in order to record that transaction, we have an accounts receivable debit for 9,000, credit fees earned for $9,000. And the reason why we know that accounts receivable is the other side of the transaction is because they gave us this hint to say that it refers to fees that have been earned but not yet billed. And so we're going to recognize the billing of them in an account receivable, and we're going to recognize the revenue fees earned. All right, so then let's look at the expenses. So the first two expenses that have changed are depreciation expenses. So to increase depreciation expense for computers, we debit. The other side of that's accumulated depreciation, credit. Depreciation expense for office furniture, in order to get the balance to go from 0 to 1,000, we debit for 1,000. We credit accumulated depreciation, office furniture. So then the next account is salary expense. We started at 9. We need to be at 10,100 to increase our salary expense. We debit 1,100 and we credit salaries payable for 1,100. And then the next account that changed is our insurance expense from 0 to 1,500. To increase our expense, we debit and we reduce our prepaid insurance with a credit. In the next one that's changed, rent expense is the same. So we have office supplies that's going from 0 to 600. So that must mean that we debited our office supply expense account for $600 to increase it. And the other side is going to be our office supply asset account. We're reducing it by the assets that are used up, $600. Our next account that changed was our utility expense from $850 to $1,000. In order to increase utilities expense, we debit, in this case, $150. We have utilities payable for $150. Okay, so hopefully you did well on those. Let's move on to the next. All right, so in this example, they're asking us to prepare the adjusting journal entries for M&R Company as of December 31st for each of the following separate cases. And so the entries can draw from the following partial chart of accounts, and they list all the accounts for us. We have to record the entries for A through F. All right, in letter A, M&R Company provided $2,000 of services to customers that are expected to pay the company back sometime in January following the company's year end. So what does our current account balance equal? Our receivable account is 0. It needs to be $2,000 to increase a receivable account, which is an asset. We debit $2,000 and we credit service revenue $2,000. In letter B, wage expense of $1,000 has been incurred, but not yet paid. So our wage payable account is 0. Should be $1,000. Wages payable is a liability. Liabilities are increased with credits. So we credit wages payable for 1,000 and we debit wage expense for 1,000. In letter C, M&R Company has a $5,000 bank loan and has incurred but not recorded 8% interest expense of $400 for the year ended December 31st. The company will pay $400 interest in cash on January 2nd following the year end. So we have interest that we're going to owe in the next year, but our interest payable account is currently 0. It needs to be $400. So to increase a liability account, we credit $400 and we debit interest expense for $400. M&R Company hired a firm to provide lawn services at a monthly fee of $500, with payment occurring on the 15th of the following month. Payment for December services will occur on January 15th following the company's year end. So we owe lawn services payable of $500, but our current balance is zero. To increase a liability account, we credit. So we credit lawn services for $500. Lawn services payable, rather. We debit lawn service expense for $500. Letter E, M&R Company has earned $200 in interest revenue from investments. Interest revenue will be received on January 15th following the company's year end. What does our balance equal? Currently zero, but it needs to be $200. So we have a interest receivable account. That's an asset. Assets are increased with debits, so we debit interest receivable and we credit interest revenue. In letter F, salary expense of $900 has been earned by supervisors but not paid. So our salary payable is zero. It needs to be $900. To increase liability accounts, we debit or credit, sorry. Credit salaries payable $900. Debit salary expense for $900. Okay. All right, so this is the exact same problem, just some different numbers. So why don't you pause the recording, take a stab at it, resume the recording, and we'll go through the answers. Okay, M&R Company provided $4,000 in services to customers, and they're expected to pay them sometime following the company's year end. Well, we want to recognize that receivable, right? So our balance is zero, but it should be $4,000. To increase asset accounts, we debit accounts receivable $4,000, credit service revenue $4,000. Wage expense of $2,000 has been incurred but not paid. Our wage is payable zero, but it needs to be $2,000. To increase liability accounts, we credit. So we credit salaries payable or wages payable, and we debit wage expense, $2,000. In letter C, M&R Company has $10,000 bank loan and has incurred but not recorded 8% interest, which is $800, they tell us. So our interest payable balance is currently zero, but it should be $800 at the end of the year. So in order to increase liability accounts, we credit. So we credit interest payable and we debit interest expense. M&R Company hired a firm to provide lawn services for a monthly fee of $300, where payment occurs the next month. So what is our current balance equal? Zero, and our lawn services payable. It needs to equal $300. To increase our liability accounts, we credit. So we credit lawn services payable and we debit lawn service expense. All right, letter E. M&R Company has earned $400 in interest revenue from investments, and it will not be received until January 15th. Just because we're not going to collect it until January 15th doesn't mean that we can't record that revenue today. So our interest receivable is zero. It needs to be $400. To increase asset accounts, we debit interest receivable for $400, credit interest revenue for $400. All right, last one, letter F, salary expense of $700 has been earned but not paid. Well, just because it hasn't been paid doesn't mean that you don't have to recognize the expense in the current period, right? So what is our balance equal in our salaries payable? Zero, but it should be $700. To increase liability accounts, we credit. So we credit salaries payable and we debit salaries expense. Okay, so hopefully you're getting the hang of these. Let's move on to the next concept. So completing the worksheet. So the following data was taken from the unadjusted trial balance of Westcott Company. Each account carries a normal balance, and the accounts here are shown in alphabetical order. Use the following adjustment information to complete the worksheet. Okay, so our accounts and the balances in alphabetical order are at the top left-hand side of our screen. The A through E adjustments are there on the top right-hand side of our screen. And what they're asking us to do is to pull down all of the balances in the appropriate order and in the right debit or credit column for our unadjusted trial balance. Then we're going to record the A through E adjustments, prepare the adjusted trial balance, and then transfer the balances to either the income statement or the balance sheet as appropriate. So here we go. So let's start with cash. Do we have a cash account? We do. Cash accounts have a normal balance of a debit because they're assets. So there's your $21. Then we have accounts receivable. They have a normal balance of a debit too. Then we have supplies, normal balance of a debit, belongs in the debit column. Then we have prepaid insurance, normal balance of a debit, also belongs in the debit column. Then we have equipment, normal balance of a debit, pull that one down. Then we have accumulated depreciation, that's a contra asset account, so it works the opposite of assets. So that belongs in the credit column. Then we have accounts payable for $6, that's a liability account, normal balance of a credit. Then we have unearned revenue, which is a liability as well, normal balance of a credit. Common stock, normal balance of a credit. Retained earnings, normal balance of a credit. Dividends, normal balance of a debit. Revenue, normal balance of a credit. Salary expense, normal balance of a debit. Utilities expense, normal balance of a debit. So our total assets, or total debits, sorry, $150. Total credits, $150. We balance. Let's record our entries. So in A, they tell us that we recorded depreciation on equipment. When we record depreciation on equipment, we debit depreciation expense and we credit accumulated depreciation. So in our adjustment column, we're going to place our debit for depreciation expense, and then we're going to place our credit to accumulated depreciation. Okay. When we accrue salaries, we're recognizing a salary payable, and we're recognizing salary expense, right? So to increase salary payable, or to increase salary expense, let's start there. We debit with 6. In salary payable, we credit 6. Then in C, the $12 of unearned revenue has been earned. So in our unearned revenue account, we had a $12 credit balance, but now that's been earned, and so our adjustment is a debit of 12 and a credit of 12 to our revenue. Then in letter D, supplies used at December 31st was $15. So we want to reduce our asset account supplies and we want to increase our supplies expense account. So we increase our supplies expense account with a debit and we reduce our supplies asset account with a credit. And then in the last one, we have expired insurance of $15. So we want to recognize insurance expense of $15 with a debit, and we want to reduce our prepaid insurance with a credit. So then when we take our unadjusted trial balance plus our adjustments or less our adjustments, we get our adjusted trial balance. So cash didn't change. So we had a debit balance and we still have a debit balance of 21. Receivables didn't change. Supplies, we had a debit balance of 24 and our adjustment was a credit of 15. So credits reduce, right? Asset accounts. So we have a net debit of 9. Prepaid insurance, we started with a debit of 18. We recorded a credit of 15, so we have a debit of 3. Equipment didn't change. Accumulated depreciation, we started with a credit of 15. We recorded another credit of 3, so that's a credit of 18. Accounts payable didn't change. Salaries payable, we had a 0 balance and then we recorded a credit of 6, so we have a credit of 6. Unearned revenue, we had a credit of 12 and then we recorded a debit of 12, so that's 0. Common stock, we had a credit of 10 and that didn't change. Retained earnings also didn't change. Dividends did not change either. Then we had revenue, 75 credit. We recorded additional credit of 12, so now we have 87 credit. Salary expense, we had a debit of 18. We recorded additional debit of 6, so now we have a debit of 24. Utilities expense, we had a debit of 12 and nothing changed, so we still have a debit of 12. Depreciation expense, we started with 0. We recorded a debit of 3, so now we have a debit of 3. Same thing with salaries expense, or supplies expense rather. We had a 0 balance. We recorded a debit of 15. So we have a debit of 15. And then insurance expense, debit of 15, and now we have a debit balance of 15. $159 worth of debits, $159 worth of credits. We're still doing good. All right, so now what they want us to do is transfer these accounts to the appropriate side, whether it's income statement or balance sheet. So let's start with income statement. So income statement, revenues less expenses, right? So our revenue account, our $87 credit goes there. Our expenses, $24 of salary expense, $12 of utilities, $3 of depreciation, and $15 of supplies and insurance. Okay. Then we have $87 of total credits. We have $69 of total debits. So that means our net income is 18, right? So now we have $87 and $87. Okay. So then if we move to our balance sheet, cash as an asset belongs on the debit side, right? So we have $12, $9, $3, $39. We have our $18 of accumulated depreciation, right? 6 of accounts payable, 6 of salaries payable. We have no more unearned revenue. Common stock of 10, and now our retained earnings of 32. We have dividends of 6, and so we should have total debits of $90. We have total credits of $72, and we have net income of 18 that flows to our retained earnings. So we have $90 and $90, and we're in balance. Okay, so this is the exact same problem as the last one, just different numbers. So you know the drill. Pause the recording. When you're finished, resume and we can go through the answers. Okay, so let's start here. Let's bring our cash account down. Normal balance of a debit. Accounts receivable, normal balance of a debit. Same thing for supplies. Same thing for prepaid insurance. Same thing for equipment. Accumulated depreciation is a contra asset account, so it has a normal balance of a credit. Then we have accounts payable, normal balance of a credit. Unearned revenue, normal balance of a credit. Common stock, normal balance of a credit. Retained earnings, also a normal balance of a credit. Dividends, normal balance of a debit. Revenue, normal balance of a credit. Salary expense, normal balance of a debit. Same thing for utilities. So we have total debits of $320 and normal credits of $320. So now, using the information in A through E, let's record the adjustments. The one correction I want to make here It's not supplies available, it's supplies. Hold on. Supplies, replace available with used. Okay. So I'm sorry if that tripped you up. All right, so depreciation, our adjustment is debit to depreciation expense of 4 and credit to accumulated depreciation of 4. Accrued salaries is a debit of salary expense of 9 and a credit to salaries payable of 9. $31 of unearned revenue has been earned, so we reduce our unearned revenue with a debit, and we record revenue with a credit, 31. And then our supplies used, oh, this one worked right, sorry. Supplies used, we had 42. We have available at the end 32, so we've used 10. So let me erase this, sorry. On my example, it was the other way around. All right, so these aren't exactly the same, they're a little bit different. So let me backtrack here a second. So your entry for supplies available at December 31st, you had 42 to start the year. You used, if you have available at December 31st, 32, then you've used 10. And so the way to record the use of $10 worth of supplies, debit to supplies expense for 10 and credit to supplies for 10. And then we have insurance expense. So they say that our insurance started at 36. Our expired portion of insurance is 32. So we're going to reduce our prepaid insurance by 32 and we're going to recognize insurance expense of 32. So $32 debit to insurance expense and $32 credit to prepaid insurance. So all of our debits equal all of our credits, we hope, for our adjustments, and they do. And then we do the math going across, right? So cash didn't change, accounts receivable didn't change. Supplies, we had a debit of 42. We recorded a credit of 10, so that means we have a net debit of 32. Prepaid insurance, we had a debit of 36. We recorded a credit of 32, net debit of 4. Equipment didn't change. Accumulated depreciation did. We started with a credit of 33. We added $4 in credits, so we have 37 now. Accounts payable did not change. Salaries payable, we had 0. We recorded credits of 9, so we have a credit of 9. Unearned revenue, we started with a debit of 31, or I'm sorry, a credit of 31. We recorded a debit of 31, so we have 0 now. Common stock did not change. Retained earnings did not change. Dividends did not change. Revenue did. We started with credits of 165. We recorded credits of 31, so now we have credits of 196. Salaries, we started with debits of 36. We recorded debits of 9, so we have debits of 45. Utilities expense, we started with debits of 30. We did not make any adjustments, so we still have 30. Depreciation expense, we started with 0. We recorded $4 worth of debits, so we have a debit of 4. Same thing with supplies expense and insurance expense. We started at 0, recorded 10, so now we have 10. Started with 0 of insurance, recorded 32, so now we have 32. So our adjusted debits should be 333 and our adjusted credits should be 333, and they are. Okay, so now what they want us to do is just move those balances into the appropriate columns. Do they belong on the balance sheet or do they belong on the income statement? And so let's start with revenues. Revenues are income statement, so are all of the expense accounts. So when we do that, we have a total of 121 in expenses and we have 196 in revenue. It's because the difference is net income, right? So net income of 75, and then you have 196 and 196. Okay. So then on your balance sheet side, cash, AR, supplies, prepaid, equipment, accumulated, payables, common stock, retained earnings, that's the beginning of the period retained earnings. That does not include our current year net income. So that's still at 50. And then when we put all of our other balances here, we end up with $212 worth of debits on our balance sheet and 137 worth of credits, and that's because net income of 75 will get rolled into and added to this $50 in retained earnings, and then we'll end up with 212 and 212. Okay? All right, so preparing financial statement. Using the following adjusted trial balance of Wilson Trucking Company to prepare the income statement of retained earnings for the year ended December 31st, 2018. Its unclassified balance sheet as of December 31st, 2018. So the retained earnings balance in the account is 155 at December 31st, 17, or the beginning of the year. So what they're trying to tell you here on the trial balance is that the retained earnings that you see here of 155,000 is as of the beginning of the year, because none of the current year earnings and dividends have been closed into that yet, okay? So here we go. So there's our trial balance. So we know from previous examples and from previous chapters that our income statement is revenues less expenses. We know that our statement of retained earnings is beginning of the year retained earnings less dividends plus net income equals end of the year retained earnings. And then we know where our assets and our liabilities and our equity accounts belong, right? So let's go. So all of our asset accounts belong on the left side of our balance sheet, right? All you're doing is just transferring the balances down. We know that all of our liability accounts belong on the top right-hand side. All you're doing is just transferring the balances down. We know that common stock belongs in our equity section. We know that beginning of the year retained earnings is 155. They told us that. We know that dividends belongs on our statement of retained earnings. We know that our revenues and expenses belong on our our income statement rather. So we know that net income is equal to revenue less expense. Then we know that net income number gets transferred down here to our statement of retained earnings. And then we know our ending balance in our statement of retained earnings belongs down here in our balance sheet, right? Easy peasy. All right, you know the drill. Here's a trial balance. Same idea as the first one. Pause the recording, take a stab at it, and then resume the recording and you can see how you did. All right, so same thing here. We know that all of our asset accounts belong on our balance sheet. So cash, AR, office supplies, trucks, land. Our liabilities, our accounts with payables in the name, belong on the right-hand side here. We know that common stock belongs in our equity section. We know the beginning of the year retained earnings is 125,000 because they told us. We also know that dividends belongs on our statement of retained earnings. We know that our revenues belong on our income statement. We know our expenses belong on our income statement. We know that revenues less expenses equals net income. And we know we need to prepare the income statement first because then that net income number moves to our statement of retained earnings, right? And then we know our ending balance in our statement of retained earnings belongs to our balance sheet. Total assets equals total equities, total liabilities plus equity, 238,000. Okay? So really the process of preparing financial statements is really, once you have your trial balance, it's really just making sure you know what accounts belong on what statements and transferring the balances correctly. I mean, it's really not much more to it. Okay? The hard part is the journal entries and getting the balances to the point of the trial balance. Okay? All right, so preparing a classified balance sheet. So if we use the following adjusted trial balance of Wilson Trucking Company to prepare the company's classified balance sheet as of December 31st, 18. So if you remember, we said that a classified balance sheet had major categories of assets and major categories of liabilities, right? So you have current assets, plan assets, and sometimes you have investment assets. In this case, we don't. And under the liability section, we have current liabilities and we have long-term liabilities. And then we have our equity, of course, right? So current assets is anything that's going to be readily converted or easily converted into cash within a year. And so that's going to be obviously your cash account and your accounts receivable and your office supplies. Plant assets are the long-term, real expensive things like trucks, equipment, land, buildings, that sort of thing. Those are all plant assets, so they go to this section. Land is not depreciated, that's why you don't see accumulated depreciation account. So we have total assets of $249,500. Then our current liabilities are going to be anything that's due within a year. So that's going to be your accounts payable, your interest payable. Long-term liabilities usually have long-term in the name, but otherwise note payables tend to be an indicator of a long-term liability. Okay. And then we move our equity section down here. Our retained earnings balance, we're going to compute, right? So we know we start with 155, less our dividends, plus our revenue, less our expenses. That's our expanded accounting equation, right? If you remember that. So if you sum all those debits and credits, you end up with a net credit of $160,500. And then you have total equity or total liabilities and equity of $249,500. You're in balance. All right, so once again, you know the drill. Using the following information, prepare the classified balance sheet. Okay, so let's set up our sections. So we have assets current and plant, liabilities current and long-term, and then our equity section, right? So current assets readily convertible into cash. So that's going to be your cash, your AR, and your office supplies. Plant assets are going to be your long-term expensive items, trucks, land, buildings, that kind of thing. In this case, we just have trucks and land. So we have total assets of $238,000. We have liabilities of accounts payable and interest payable. Those are current, due within a year. Long term says long term, so that's easy. And then our equity section, we have common stock, and then they're going to ask you to compute your retained earnings. You know, retained earnings is your beginning retained earnings less your dividends plus your net income, which is the same as retained earnings less dividends plus revenue less expenses, right? So that's going to compute to $138,000 for a total of $238,000 of liabilities and equity. All right, so in this example, we're going to prepare the closing entries. And it says the following are the Nintendo's revenues and expense accounts for the recent calendar year, yen in millions. So we've got 504,000 of sales, 283 of cost of sales, some advertising expense, and other expense. Okay, so if we're going to prepare the company's closing entries for its revenue and expense accounts, remember we use that income summary account? So we have net sales of 504, that's a credit balance. And so in order to make that credit balance go away or to close it, we need to debit revenues or debit net sales and credit income summary. And then our cost of sales and our advertising expenses and our other expenses are all debit balances, right? So to close those, we're going to debit income summary and we're going to credit all of our expense accounts. Okay. So why don't you take a stab at that same type of problem, different numbers, same approach. Pause the recording. When you're through, resume, and we can see how you've done. Okay, so we know that when we close our income statement accounts, we need to do the opposite to take the balance to zero, right? So net sales has a credit balance. If we want that balance to go to zero, we're going to debit net sales and we're going to credit income summary. And then to close our expense accounts, we're going to debit income summary and we're going to credit all of our individual expense accounts. right? They have a debit balance, the credit balance takes them to zero. And that's how we close our revenue and expense accounts. Okay, so in this problem, they're asking us to compute the profit margin for each company separately in A through E. So if you remember, our profit margin formula was net income divided by net sales equals profit margin. And so it's really just a simple division problem for each of A through E. So in problem, or letter A, 4,361 divided by 44,500 is 9.8%. 97,706 divided by 398,800, 24.5%. Then in C, 111,281 divided by 257, 43.3. D is 4.5. And E is 18.4. And so then what they're asking is which of the 5 companies is the most profitable according to the profit margin ratio. And so the higher the profit margin, the more profitable the company is, right? So in that case, it would be C. Okay, so here's the exact same problem. So why don't you take a minute, see if you can solve A through E, and when you're finished, resume the recording, and we can check your answers. Okay, so again, profit margin is net income divided by net sales. So let me just pull up all the answers here. Give you a second to check yours. Okay, and then which of the 5 companies is most profitable according to the profit margin ratio? In this case, it would be company C. Okay. All right, so analyzing and computing the current ratio. So what they're asking for us to do here is to calculate the current ratio in each of the following companies, round to the nearest 2 decimals, and then identify the company with the strongest liquidity position. So current ratio is current assets divided by current liabilities, okay? So current assets of 79,040 divided by current liabilities of 32 would be a current ratio of 2.47. Wonka Company, 104,880 divided by 76. It's a current ratio of 1.38. Payday, current ratio of 0.92. Kit Kat, current ratio of 1.05. And Heath, current ratio of 61,000 divided by 100, or 0.61. And so then they're wanting us to identify the company with the strongest liquidity position. And so what the current ratio tells us is how many times, or how many, for every dollar of liabilities, how many dollars of assets a company has, basically. I think you could say it that way. And so in this case, the higher the number, the better, right? So the company with the strongest liquidity position is going to be Twix. Okay, so same problem here, just different numbers. So why don't you take a few minutes and compute the current ratio for each of the following companies, and when you're finished, you can resume the recording and check your answers. Okay, so you should have 2.65 for Twix, 1.43 for Wonka, 2.08 for Payday, 0.91 for Kit Kat, and 0.76 for Heath. So the company with the strongest liquidity position in this scenario would be Twix at 2.65. Okay, so in this problem, we're going to look at recording prepaids that are recorded as expenses and unearned revenues that are recorded as revenues. And so in Ricardo's construction company, he began operations on December 1st. In setting up his accounting procedures, the company decided to debit expense accounts when it prepays expenses and to credit revenue accounts when the customer pays in advance. So we have to prepare the journal entries in items A through D and the adjusting entries as of December 31st for the periods or for the period end items in A through G. So in A, B, C, and D, let's look at A. So supplies were purchased on December 1st for $2,000. So when they purchased supplies, they told you they debited everything that's prepaid to expense. So we're going to record supplies expense, debit 2,000 to increase it, and cash, credit 2,000 to decrease it. Then in letter B, the company prepaid its insurance premiums for $1,540 cash on December 2nd. But they told you that rather than booking those to a prepaid account, they expensed them. So our journal entry for the December 2nd transaction is going to be insurance expense for $1,540 and cash for $1,540. Then in letter C, on the 15th, the company received advance payments of $13,000 cash from its customers for remodeling work. So typically, the way we've learned it to this point, the company would record unearned revenue liability account and cash, right? But what they told us was the company's policy is to record it all to revenue, and then they adjust basically at the end of the period the other direction from everything that we've learned to date. So on December 15th, they received cash, and then they recorded revenue for $13,000. Then on December 28th, they received $3,700 cash for another customer for remodeling work to be performed in January. So we're going to debit cash to increase it, and we're going to credit remodeling fees earned to increase those. Then a physical count on December 31st indicates the company has $1,840 of supplies available. And so the way that we're going to correct that is right now they have a zero balance in their supplies asset account because when they bought them all, they expensed them. That's our December 1st transaction there. So now the physical count says we have 1,840 of supplies available, so we need to put those supplies on our balance sheet. And what that would mean is we're going to reduce our expense. So we're going to debit supplies for the amount that we have available, and we're going to credit our supplies expense because we didn't use all $2,000 worth of supplies that we originally expensed. Okay? Then in letter F, an analysis of the insurance policy shows that $340 of insurance coverage has expired. So this is one of those. This is a little bit different in that we have, oh, where's my pen? We have $1,540 in our expense, but what they're telling us is that only 340 is expired, so our balance should be 340. So in order to reduce our balance in our expense account, we're going to credit for the difference between the two. So we're going to record prepaid insurance for $1,200, and then we're going to reduce our expense with a credit of $1,200. So I wrote this a little too big, but if that's our debit column, our credit of $1,200 would be over here, right, in our T account. And that would reflect this $1,200. Okay, and then in letter G, as of December 31st, only one remodeling project had been worked on and completed. So the $5,570 fee for this project had been received in advance and recorded as remodeling fees earned. And so what they're telling us here is that our remodeling fees earned, so I think they're talking about this transaction here. So only one of these projects has been completed. So our balance in our revenue account is $13,000. Oh my, let me fix that. Our balance is $13,000, but what they're telling us is it really should just be $5,570. And so what debit do we need to reduce our revenue account from 13 to 3570? $11,130. Does that math work? Let's see. Got to get out my handy dandy 10 key. Just kidding, it's my calculator phone. My calculator phone, my phone that with the calculator app, right? It's a little late here, so bear with me as I wrap this up. So they're lumping both of these together. So let me back up. So only one of the jobs have been completed. So what they're also saying is that this job here has not been completed either at all. So really what you have is you have $7,430 for the $13,000 job. We have to reduce our revenue for $7,430 from this 13 because only one of the jobs have been completed, which also means this cash and remodeling fees earned of $3,700 has also not been completed. So if we lump both of those into a single entry, you have $7,430 plus 37. Oh my goodness gracious, 3,700, and that's how they're getting the 11,130, reducing our revenue here. And putting an unearned remodeling fees liability on our books. So let me just review that again since I led you astray here for a minute. So as of December 31st, only one remodeling project had been worked on and completed, and the fee for that was $5,570. And so let me erase all of these here. So that means of the two different jobs that we recorded, both on December 15th and December 28th, only $5,570 should be recognized in revenue. The rest of it should be in unearned revenue. And so here's what they're saying. So try to write this small enough. So if this is our revenue for remodeling fees, we recorded $13,000 and then we recorded $3,700. And what they're saying is that we should have $5,570 in that account. And so that's where the 11,130 is coming from, because if you take 13 plus 3,700 less 11,130, this gets us to our revenue that we should be recognizing for the work that has been done. And we're going to put the 11,130 on the balance sheet as an unearned remodeling fees revenue, or unearned remodeling fees is a liability account. Okay? All right. So here's the exact same problem. Why don't you pause the recording, take a few minutes, try to resolve it yourself, and then when you get stuck and or you think you've completed it, resume the recording and we'll go through the answers. Okay, so same scenario. In setting up its accounting procedures, the company decided to debit expense accounts when it prepays its expenses and credit revenue accounts when the customer pays for services in advance. So, in A, supplies are purchased on December 1st for $1,500 cash. It's a prepaid, really, but they tell you they expense it all when they pay it. That's their procedure. So we're going to debit supplies expense and we're going to credit cash. And then letter B, company prepaid its insurance premiums for $1,200 cash on December 2nd. So we have insurance expense, we debit expense to increase it, and we have cash, we credit cash to decrease it. Then letter C, on December 15th, the company receives advance payments of $10,000 cash from their customers. So they receive cash. To increase cash, we debit. And normally advance payments would go to unearned revenue account, but they tell us they record it to revenue. So we have remodeling fees earned of $10,000. Then in letter D, on December 28th, the company receives $5,000 cash from another customer for remodeling work to be performed in January. So again, we're going to increase cash and we're going to increase remodeling fees earned. All right, so a physical count of inventory on December 31st indicates that the company has $400 of supplies available. So we need to put $400 of supplies on our balance sheet. We're going to reduce our supplies expense by $400 with a credit because they only used up $1,100 of the $1,500 they purchased. In letter F, an analysis of the insurance policies shows that $300 of insurance coverage has expired. So we currently have $1,200 in our insurance expense account, but what they're telling us is that we should only have $3. So here's our $1,200. This stylus I bought is a piece of junk. Let me start over. Hold on. I guess that's what happens when you spend $10. Okay. Although it's operating like a $3 one. Okay, so we have $1,200 in our insurance expense account. We should have $300. And so in order to get a debit balance account, an expense account with a normal balance of a debit, in order to decrease an expense account, what do? We credit, right? $900. So we're going to debit prepaid insurance for $900 and we're going to credit our insurance expense for $900. And then in letter G, as of December 31st, only one remodeling project has been worked on and completed. We have two separate remodeling projects here, two separate entries. So they're saying of these two, only one has been worked on and completed, and the fee was $4,000. So right now we have earned $15,000, but the problem is we should only have earned $4,000. So if we have our revenue T account, revenue is a normal balance of a credit. So we have $15,000, but what they're saying is we should have $4,000. And so in order to get $15,000 down to $4,000 in a revenue account, revenue accounts are decreased with debits. So we need to record a debit to remodeling fees earned of $11,000 and a credit to unearned remodeling fees liability account for $11,000. Okay, so the only thing different about these problems is that they're telling you most companies' policies are to record prepaid items as prepaid, not all as expense, right? And to record revenues as unearned and then adjust them as they're earned, which is the way that we've been learning and using and going through examples up until these last two. But it's important, companies can set their policy whatever way they want when they originally record activities, so long as they're making those applicable adjusting entries. If they're an accrual basis of accounting company, they have to make these adjustments. It's just getting you to understand and be able to see the adjustments from either side of the equation, so to speak. So I'm hoping it didn't confuse you, but the ultimate goal is no matter what you do when you originally record the transaction, the ultimate goal is just to make sure that you book the appropriate adjusting entries to bring the balances to whatever they need to be at the end of that reporting period. Okay? All right. So moving on. So revenues received in advance. So Costanza Company experienced the following events and transactions during July. So they want us to prepare the journal entries, to record the events, using a procedure of initially recording, oh my goodness, look at this pen. The procedure, I can't even draw a straight line. I swear I've had nothing to drink. Okay, let me try again. All right. So using the procedure of initially crediting the unearned fees account when the payment's received from the customer in advance of performing the services. Easy peasy. We know how to do this, right? All right, let's go. All right, so July 1st, revenue of $3,000 cash was received in advance of performing the work for Vivian Solana. So what's our entry? We got cash. How do we increase cash? Debit. And we've received the cash in advance of performing the work. So what do we have? We have an unearned fees liability account for $3,000. July 6th, we received $7,500 cash in advance for performing work for Iris Haru. Same idea, right? Cash and unearned fees, right? On July 12th, we completed the job for Solana. So when we complete the job, what do we get to do? Record our revenue, right? So let's reduce our unearned fees for $3,000 and let's recognize fees earned for $3,000, right? On July 18th, we received $8,500 cash in advance of performing work for Amina Jordan. Cash, increased cash with debits, increased liabilities, it's unearned with credits. Then on July 27th, we completed the work for Haru. So that was the $7,500, right? So we've completed that work, so let's reduce our liability by $7,500. We do that with a debit. And let's recognize our revenue, fees earned, we do that with a credit for $7,500. And then on July 31st, none of the work for Jordan's been performed. Great. We don't care. You want to know why? Because we recognized it as unearned, so there is no adjusting entry needed. Trick question. I know, not fair, right? All right. So, this looks like a duplicate slide. Oh, sorry, this is part B. Here we go. So part B, they say to prepare the journal entries if their procedure was initially to credit the fees earned account when the payment's received, right? So this is the opposite direction, so to speak. So let's look at that. So receive $3,000 cash in advance for performing work for Vivian, but they record it directly to fees earned. So in this case, we record cash, increase cash with a debit, and increase fees earned revenue with credit. Same thing for July 6th, just a different amount, right? Then on July 12th, we completed the job for Solana. Well, here's the thing. This is the Solana job right here. We already recorded it to fees earned. So when we complete the job, we don't have to do anything. Okay? Then on July 18th, we received $8,500 cash in advance for performing work for Amina Jordan. So, but their policy is to record it to fees earned, right? So we're going to debit cash to increase it, and we're going to credit fees earned revenue to increase it. Then we completed the job for Haru. Well, let's see, Haru is this $7,500 job. We already recognized it as earned, so there's no entry required. And on July 31st, they tell us that none of the work for Amina Jordan's been recorded. Well, the problem with that is we recorded it as if it was, because it's an earned. So we have to fix that. So our entry is going to be to reduce our fees earned and to reduce a credit or to reduce a revenue account, we debit. and then we're going to recognize our unearned fees liability, and we're going to increase that account, and we do that with credit. Okay? So now you've seen both ways with the same example back to back. So hopefully that helps kind of clarify anything that might have been confusing about that example before last that we went through. So the key is just paying attention to the words and paying attention to what they tell you about how the company records the initial transactions. Okay? All right. Then in letter C, under each of the method, determine the amount of earned fees reported on the income statement for July and the amount of unearned fees reported on the balance sheet as of July 31st. All right, so I can't go backwards when I'm live recording this, but if we were to do that, our income statement fees earned would be $10,500 and our unearned fees would be $8,500. That's if we initially, that's letter A, when we initially record our transactions to the unearned fees. When we initially record our transactions to the fees earned, it's going to be $10,500. And unearned fees is going to be $8,500. The point being, it doesn't matter which way you record your initial transactions, as long as you're making the true up journal entries or the adjusting entries, you're going to get to the same place at the end of the day. And that's the point they're trying to make. Okay? All right, so here's another example. Same exact problem, different numbers. Why don't you pause the recording? You know the drill. When you're ready to continue, hit resume, and we can go through the answers. Okay, so assuming that they record everything to unearned to start, when they receive the cash in advance for Vivian, we're going to debit cash to increase it, and we're going to credit unearned fees to increase that. It's liability. On July 6th, we received $6,000 cash in advance for performing work for Haru. So we're going to increase, we're going to increase cash with a debit of $6,000, and we're going to increase our unearned fees liability with a credit of $6,000. Then on July 12th, when we completed the job for Selena, we're going to recognize that revenue. So we're going to reduce our unearned fees revenue, or liability, sorry. And to do that, we debit. And we're going to record fees earned, which is a revenue account. And to do that, we credit. Then on July 18th, we received $4,000 cash in advance for performing work for Amina. So we're going to debit cash to increase it. And we're going to credit our unearned fees liability to increase it. Then on the 27th, we completed the job for Haru. And so we need to recognize that revenue. So we're going to reduce our unearned fees liability, and we reduce liabilities with debits. And we're going to increase our revenue, and we record revenue or increase revenue with credits. Okay? And then on July 31st, none of the work for Jordan had been performed, and that's okay because we didn't record it as earned. Oops, wrong one. That's okay because we didn't record it as earned. We recorded it as unearned, right? So there's no entry needed for that guy. And then as I was doing this, to the right-hand side of the screen, all of the debits and credits were being posted to the T accounts. So you'll see at the end of the day, we've got a $4,000 balance in our unearned fees and a $10,500 balance in our fees earned. So then in part B, if we assume that they initially credit fees earned those entries look like? Debit cash for $4,500. Credit fees earned for $4,500, right? Then on July 6th, credit cash for $6. Debit fees earned for $6. Same idea, different amount. Then when we complete the job for Selena, we don't have to do anything because here's how we originally recorded it to fees earned, right? Then on July 18th, when we receive $4,000 cash in advance, debit cash, credit fees earned. Then on July 27th, there's no journal entry required because the job for Haru was already recorded to fees earned. Then on July 31st, none of the work for Jordan had been performed. So here's what we have to do. We have to reverse those fees earned with a debit. We reduce revenue with a debit. And we record a liability by crediting unearned fees. And so in Part C, under each method, determining the amount of fees earned and the amount of unearned fees, same idea, right? So when we initially record them as a liability, here's what happens. When we initially record them as a revenue, here's what happens. But see, you get to the same spot because you're making those adjustments. It's just whether you're making the adjustments to the fees earned account or you're making it to the unearned fees account. Okay? So hopefully that helps kind of differentiate between the two ways, but you get to the same answer, okay? Okay, guys, that's it for the Chapter 3 exercises. Hopefully you'll find these to be helpful as you're going through the homework. But as always, if you have any questions, please don't hesitate to reach out. Good luck.